My name's James Hooper, for those of you who don't know me. I'm a partner in the tax and business services side of HLB, and I also oversee our property management business. The NRAS scheme really kicked off about 5 or 6 years ago. It was a federal government scheme that was really designed to breach a gap in the market for affordable housing as property prices were becoming quite expensive for people. It was primarily, the first 3 rounds of NRAS were primarily taken up by not-for-profits and charities until private enterprise really came on board with full force about when round 4 was announced. And that's the properties that you're seeing probably advertised a bit on TV are primarily coming out of round 4 at this stage. Probably one of the main participants was a group called Affordable Housing Consulting, who received over about 1,000 incentives out of round 4. And the group that they do most of their selling through is Building Assets. It's represented by Rob Mitchell, who I've been friends with for quite a long time, also a client of the firm, so I certainly trust Rob implicitly. We've also got Peter Gillard from Pathway Finance here, just to give you a bit of background with respect to finance and how that interrelates with respect to things such as loan-to-value ratios that banks are looking for, how much equity you need in your property, etc. So I'll first introduce Rob to get up and say a few words about the NRAS scheme, followed by Peter Gillard. Over to you, Rob, and then we'll have Peter to follow. Thank you.
Thank you, mate. Thanks, James. Hi, everyone. As James said, my name's Rob Mitchell. I'm the one of the owners of Building Assets. NRAS, a lot of you would have seen it advertised now in the cinemas or on the TV or in the newspaper. It's the National Rental Affordability Scheme. The information abounds on property blogs. It is very accessible everywhere. As James said, the National Rental Affordability Scheme was brought out by Mr. Rudd in 2008, and the idea of the incentives were to be twofold. It was to get more new properties on the ground, but also to incentivise what the public service call their key service workers, so AMBOs, young fireys, nurses, that middle range, come in, that middle range of key service workers who felt quite rightly that they were getting forced out of the rental market, where they used to be able to rent at Clemzig, they had to rent at Surrey Downs, and when they used to be able to rent at Marion, now they're having to rent at Shiloh Park and Aldinga because the rent values were steepling. So the idea of NRAS was to do twofold: to incentivise landlords by providing a tax-free incentive, and also incentivise the tenants by giving a discounted rent. So we started with much vigour and not a lot of knowledge of what was going to happen in 2009, with 38 incentives, of which Divine Homes, this is a bit of a background to where we are. Divine Homes built all the houses for us, and they were in the deep north and the deep south, so Manopara and Aldinga, and not much in between, and they got absorbed very quickly, and we went on and had another round, and we did a lot more of the far-reaching suburbs. Now, the reason I raise that is that in this round, so we're currently in round 4 of the National Rental Affordability Scheme, and what differentiated this round was that the government, particularly the state government, have been very hot on what they call the transport-orientated developments, or TODs. So anything that's around a shopping centre, anything that's around railway, anything that's around key employment hubs, the government had made it known they were very keen on. But the notion of affordable housing and being in infill hadn't worked unless it was really small apartments. But our sister company, Affordable Housing Consulting, put an application in that really took advantage of those suburbs, and we'll show you some properties that are available in that space now, which are quite well-known suburbs like Seacon Gardens and Clovelly Park and Sturt and Mitchell Park around Westfield Marion, and around the QEH, Woodville and Findon and Kidman Park. So those suburbs, and out in the northeast, Northgate, Lightsview, Clearview, those type of suburbs, which certainly weren't available in the first couple of rounds of NRAS. So some people that looked at it originally and said, oh, that's a bit far out. Now we've got a significant number of properties in the infill space, and certainly the CBD is well covered. We've got about 100 properties we'll be dealing with in the CBD. So anyone who's got a liking to a townhouse or an apartment in the city, they're certainly covered now. And we'll flesh out some details about the properties in a sec. Okay, so we're building assets. I'll bring up the details of our website in a sec. We're differentiated by the fact we only do NRAS properties. We don't sell any other property other than NRAS properties. And our offering is very much aligned to affordable housing consulting, who has, of the 1,500 or 1,600 allocations that are available on the market, affordable housing consulting manage about 1,450 of them. So certainly AHC have got the majority of the for-profit NRAS allocation. So building assets is effectively like your local real estate agent, but we only work with the NRAS properties, and we work so that both the agreement and the government funding and the property and everything else that needs to flow all flows in a nice, neat process. It's always nice to spend some time with an HLB. As James said, we met at university 15 years ago, when in that time James has built up quite a significant not-for-profit and for-profit property management business inside the HLB business, and that certainly suited us with our offering. We wanted a one-stop shop where any of our purchasers could get their potentially their accounting done, but certainly get their property management done in a neat and effective manner. And that's certainly with the scale we're dealing with now. We've got 560 properties on the ground now through the consortium. So certainly for anyone looking at doing something with us, we've got a lot of experience now with getting properties on the ground and getting good results. And that all comes from just having a very streamlined, very neat arrangement. And we'll talk about that a little bit more when we get to the actual properties. So certainly if you're a client of HLB, that will give you some comfort, because both your accounting and your property management can all be domiciled under the one roof. Okay, so there's a stack of information on the web about NRAS, but a quick précis is that it's a federal government scheme. It's backed by the state government as well. There's 50,000 allocations that have been apportioned, of which, for those who worry about it getting wound back or rolled back, that is legislated. That this round is the funding is locked in for the full 10 years, and that when someone purchases a property, that extends 10 years from the practical completion of the settlement date, not 10 years from when the scheme started. So, as you can imagine, tonight's presentation is just a bit of a top-down review of where it is, and we'll have a bit of fun looking at the properties in a minute. And certainly on our website and on the federal government's website, there's a lot more meat on the bone as to exactly who does what in the process. And certainly from my end or James's end, we can help you out with that in a bit more detail. The big kicker is that the federal government, to incentivise you to discount your rent by 20%, is they provide this year the NRAS amount is $9,981. That's tax-free. Now next year that will go up to approximately $10,400. We don't have the exact number yet, but it'll be approximately $10,400. And again, there's a mechanism that all of the rents and the NRAS rise each year. When we show you the calculator in a minute, you'll see that the nature of that tax-free money, along with the normal deductions you would derive by having any investment property, make a big difference to the cash flow, and that's where all the noise is coming from. NRAS people are able to buy nice new properties close to the city, which has always been a defensive long-term play, but have their cash flow looked after by the subsidy from the government. And we'll have a look at the calculators to give you some numbers on that in a sec. The price points, we still do have some properties that are in the outer reaches. Aldinga's been a very, very popular hotspot. So Seaford have continued to be hotspots with the new rail line running down to Seaford. Some of the smaller two-bedroom units that the state government have developed are in that price point there of around $260,000. So certainly, again, if you when we have a look at our website in a minute, you'll see that the lower price properties, the NRAS is static, so it's the same amount whether it's a $400,000 property or a $250,000 property. So you can certainly see the ones, the lower price point properties show resoundingly strong yields. And again, for some people that we're seeing them buy a more expensive one and a cheaper one to get a hold of two incentives, and the smaller, cheaper unit is effectively used as just a bit of a cash flow slave. But we can talk about that a bit more. Still, it's good property, nice new property, and again, traditional house and land packages in Mount Barker and Morphett Vale, and to a lesser extent in the northern suburbs, because they were very heavily subscribed in round two, but still house and land packages in the mid 350s. So our website, generally we've got 14 or 15 separate projects running concurrently at one stage, and each of those projects might have between 2 and 10 different properties in it. Depends on what sector it is and what stage of the release cycle we've done. But when you dig into our website, you see that everything that anyone might need, or at least to get started with your due diligence, is all available on the website. And in the back end of the website is a very, very strong calculator that works out both the NRAS, and does the different calculations for the different tax brackets. And in the last year, we've had self-managed super ownership added to the website, so you can click on the part that's for self-managed super, and that will work at the different tax rates. And we've also had the $8,500 construction grant added to the back end of the site as well. So works out some pretty strong cash flows, and also has all of the provision of details of where the property is and all the rest of its characteristics. So the type of property, when we started, as we said, the traditional style of property were on the traditional 300 square metres of land with a house at Seaford, price point $320,000 to $350,000. They'd been, and that's the sort of house that both Divine and Metro Homes had been building for us since 2009. Again, very popular with tenants, always very heavily subscribed at the open inspection for the tenancies with those type of properties. We'd expect to see young families, maybe either the husband or the wife working full-time and one working part-time with a couple of kids in the local school. That seems to be the demographic of the tenants, and James can probably give you a bit more information about the actual tenancies in a one-on-one. Mount Barker have bigger blocks of land, 600 square metres typically, with a double garage, 170 square metre house, and they're around, again, about $400,000, and have continued to be very popular. And again, the traditional suburbs that you would expect, a little bit over the hill or a little bit in the north, in those more reasonable price points with a bit of land underneath. This is the change that's come about in the last 12 months or the last 15 months that have been incredibly popular. The advent of the two-storey townhouse and the single-storey two-bedroom homette. Quattro Homes at Glenelg were very successful in the application process to get funding for this round, and they had proved that they could deliver significant infill properties, which certainly all the minister and everyone else involved were very keen on. Anything that where the land was a little bit scarce, and they wanted more people living in that space. So typically the suburbs that we'd expect to see are Seacombe Gardens, Sturt, Warradale, Kilburn, Woodville, etc. So anything in that ring between 2 and 7 kilometres out. We've just released a release at St Clair just a few weeks ago, which was oversubscribed. 15 properties snapped up pretty quickly, so we've got an application in to try and get some more allocations in there. But that type of development, anything in the infill with a nice, pretty new fit out has been very popular with investors, and that typically would see a tenancy of maybe 2 adults, 1 kid, or 2 adults, 2 kids in that type of space, working at, we certainly know the ones around Westfield Marion, a lot of employment around the new Mitsubishi site, around Flinders Uni and around Flinders Hospital, both public and private. So they're big employment hotbeds, and lots of tenants around for the properties we've got coming up. And then the high density, which we didn't have last time. So the government are very keen on CBD living, very keen indeed. So there's 2 projects that are up in the city at the moment. One is the UNO development that the state government did with federal government funding that we're working our way through. But the most resounding success of any NRAS project we've released has been the art development that was released on Flinders Street, just across from the CBC pool in when was that? November, December last year, Rach? Yep. And that it was a bit of a collision of a lot of events at the one time. There was in the CBD, there's no stamp duty at the moment. Under $400,000 price point properties have got an $8,500 construction grant to go with them, and the property has an NRAS allocation. So for someone looking at investing in the CBD, that was all just a bit too good to be true. And it also ticked the boxes for self-managed super funds to buy. So I think that was it was just all the right things at the right time. Now there's still a couple left in the art development, and we do have 2 more smaller CBD developments coming up. So anyone looking for something that's very low touch with huge tenancy prospects, I think the CBD looks pretty good. So we often get, I mean, when we first started, we really didn't know what the tenants were going to be like. We hoped we'd get a nice cross section. What we have seen is that we've been hugely pleasantly surprised by the nature of the tenants, how many applications we've received, where they're coming from. Interestingly, when Mr. Rudd released the NRAS legislation, the cabinet, there was no differentiation for whether you're in New South Wales or whether you're in South Australia. So our NRAS allowance at $9,981 is exactly the same in Adelaide as it is in Sydney, which doesn't really make sense when our median is $150,000 less than Sydney. So both our income limits with the 2 adults, 2 kids. Again, our website's got all the detail. There's a lot of meat on the bone on the website. But as an example, 2 adults and 3 kids at Mount Barker, that family income can be $108,000 gross, approximately, and that family is still eligible to be an NRAS tenant and get the discounted rent. So as you can imagine, and as James would probably attest, we're not seeing families who are butting right up to the 108. We're seeing maybe the wife working, earning $65,000 a year, the husband working part-time, and the 3 kids at the local school. That's not getting anywhere near the income allowance. So we don't. We've got a very wide range of tenants. What we've also been pleasantly surprised with is that $80 a week discount off a property at Mount Barker is a heck of an incentive to both pay your rent and to behave. And when we were 20 or 30 properties in, we were pleasantly surprised and thought it might have been a bit of a coincidence. But with the consortium, 560 properties in there, I think that's far more than a coincidence. The self-interest certainly rules for the tenants, and if you've got a chance to get a brand new property, or say a brand new apartment in the CBD for $320 a week rather than $400, you can see self-interest rules. They pay their rent, do the right thing, and so certainly the tenancy risk is not a major issue. Okay, this is, and apologies for all the accountants in the room, because this is a gross generalisation, but what we try and encapsulate here is where the difference is, because people, you say, oh, there's $9,981 coming to you for the year, and okay, well, big deal. That's a lot. It's a $400,000 property. That's not that in the big scheme of things. It's not that much. But the nature of the tax-free NRAS, the way that flows through, particularly to people in the second to top and top tax bracket, is exceptional. And that, again, I'm not sure whether the government really thought through the metrics of it, because we certainly, from the people we've dealt with our buyers, they would have bought even if the allocation was taxed, or if it was half as much. It's just a nice high figure. But if you can see, working down, so we're comparing two exact same properties right next to each other, and in this instance, $350 a week is probably a little 3-bedroom house at Seaford. So if you can picture the single garage, nice little investment property down near the Seaford shopping centre. We're both assuming 52 weeks of rent, so $18,200 each a year. Now, with the NRAS properties, you need to discount the rent by 20%, and that's not your job to do. Your property manager will do that all for you, so it's not you don't need to concern yourself with that. And then, of course, Affordable Housing Consulting have been beavering away at this for a few years, so they need to get paid their management fee, so you need to factor that in. So you can see on the line of the gross assessable income, the traditional rental is still at $18,200. Nothing's been touched there, but the NRAS property has had its gross assessable income lowered down to $13,310. Where everyone forgets to do their sums is that on that assessable income, your tax is considerably less. So you're paying about $1,876 less tax on that assessable income for the rental income. Then you pop the NRAS income on top, which is $9,981 tax-free. You can see the resounding difference to the actual in-your-pocket rental income after tax. Now that rings about true with a property that would be $140 a week cash flow positive. Now bear in mind there are all other manner of deductions and the like that need to be considered there, but that's on a like-for-like property. The nature of the tax-free grant plus the deduction which of the rent, which lowers the assessable income, makes a huge difference to the cash flow, and that's why in particular accountants and to some extent financial advisors, but certainly accountants who have had a good look at this for their clients who are of defensive in nature and particularly like the idea of a property that, well, we use the word feeds itself, but a property that the cash flow is going to look after itself. That's why the NRAS properties have been resoundingly popular. South Australia is not a bad story at the moment, and certainly we're seeing some good positive signs. The old bugbear down the bottom. Well, the property prices will double every 7 to 13 years. We're using a pretty long-term average back from when the first prices were recorded. But South Australia is. We're listening to an economist at a lunch last week, and he noted that we were optimistic pessimists, and I think that we've probably still got a few more months to run, maybe past the election. But we're seeing the prices and the valuations of our NRAS properties hold up to date. We're not seeing anything alarming. The story is good in South Australia. The money's cheap. It's not a bad time to be out looking at a property, particularly when the state government in particular is incentivising buying so heavily with the construction grant and the stamp duty and the NRAS on top. It's pretty good going. And this is Alan Kohler's graph from a year ago, but it still shows the same thing. They predict that there's a housing market imbalance, which is not as marked in South Australia, but certainly in some areas there the rental there's a shortfall of rentals, and anything that's driving demand for rentals is inevitably going to help landlords who are owning properties. And we're seeing the people that have got the NRAS properties, they're in a higher demand because they're cheaper. So they're the first people they're the first properties they're getting soaked up. So for our landlords, they're going well because their properties are the first ones that are getting taken up. So again, using an example following on from the one that we spoke about before, explaining, this comes back to when Rachel first joined us, our marketing manager, trying to explain what the difference was between buying a traditional property in the suburbs at Clemzig as against buying a new property and what benefit might be there, and then buying an NRAS property. So we use our traditional little 1970s brick home at Clemzig. That type of rental, a lot of land underneath, would typically, and again we've spoken to our accounting friends about this to get some approximates, would typically cost the investor about 10 grand a year to hold. And you're all waiting for a bit of capital growth to come, so about $200 a week. A little property down at Aldinga, it's higher rental, higher coverage, and a bit better yield because there's a new property, a bit more demand. That might get an investor, might cost them about $100, about 5 grand a year to hold. Now, with the same property, with an NRAS allocation, and that's factual for someone in the top tax bracket, that little property with an NRAS allocation attached to it was $137 cash flow positive. So again, everyone's circumstances change, and every single person that comes into us have got a different circumstance. Some put their properties into a family trust, some have got it in a self-managed super fund, some are top tax bracket, some have got 1% in their husband's name and 99% the wife. So everyone bakes the cake slightly differently, but holding everything at normal, the NRAS allocation makes a massive difference to the cash flow and the holding costs. And that's exhibited when someone's looking at just a basic little number. Traditional, how many houses can own? A little $350,000 house. After 10 years, you'd hope it's going to rise to $700,000. That's the plan. We're not buying for it not to rise. This is the big difference with the NRAS and why people are taking it up. The property without the NRAS, like think the Aldinga one, is going to cost about $100 a week to hold and service, and you're copping that loss with a view that we're going to see some upside down the track. The NRAS just makes a big difference, makes the holding costs a bit easier. Big difference when you've got 3, and we've got some of our clients who have got 3 properties now. That's a big difference of $1,200 a month of positive cash flow as against $1,200 going out. If you're planning on getting up to 2 or 3 properties, that cash flow, the NRAS cash flow, makes a big difference to both the holding costs. Now, Peter will speak at the moment about the banks. The banks don't include the NRAS income in their serviceability yet, although it's taken some time. The banks have only really come on board in the last 6 to 9 months, and now they're all seen to be cheerleaders for the NRAS offering. So, but certainly anyone looking at developing a portfolio that's got more than 1 or 2 properties, NRAS makes a big difference just for the cash flow. And again, Rachel's graph, traditionally you're a little bit back from the tax band, get some from the tenant, you have to tip in a fair bit yourself, then negative gearing comes along and you get to write off a little bit more on tax. The NRAS has effectively just jumped in and replaced you. So rather than you tipping in, the NRAS makes the difference. I tell you, 100 from holding a number of properties at one time, when you're getting all the bills come in for all the properties, they all seem to go at the same time, having properties that are coming in with the subsidy from the government makes a heck of a lot of difference, especially if you've got a couple of them and you're getting 2 lots of NRAS incentives. So again, we'll have a look at the website just quickly now to give you a bit of an example as what's available. But as we said, it's a ripping time to do it now. The state government incentive of $8,500 finishes on June the 30th. We understand there's no sign that's being extended now. So anyone buying in the CBD gets a chance to get both no stamp duty, $8,500 construction grant, and an NRAS allocation, which again is a lot of carrot to get you to make a consideration to buy. And again, because of the nature of the cash flow of these properties, they are very much designed for set and forget. Buy it, park it, particularly for self-managed super funds. It's absolutely perfect. So this is live right now. So anyone tonight, now we are down. We've only got 5 projects up at the moment. We expect we've been very good boys and girls. We've been selling very well, and it's been quite remarkable. So we're just We're just waiting on a big replenishment of stock, but this will give you a bit of an idea as to what's available. So that's the apartments at the top. That's the one that the state government developed with some federal government funding, and there's still 9 properties available there. You'll see on the website there's a lot of information at hand. So the calculator in the back end does a power of working out up here. You've got an ability to put your taxable income in, and how you're going to have your loan. Money's a bit cheaper than 6.99% at the moment, so have a bit of a fiddle around with that, and again, what entity you're going to, what you're going to put it in, and that will quite neatly work out return, cash flow, which is what most people are looking at, in both the gross and the net yield, and that's a pretty neat calculator. So when it's especially helpful when we've got a number of projects up running concurrently. Someone might be looking at and that's Bluestone is house and land at Mount Barker, which has been traditionally exceptionally popular. Forgive me just for scrolling down. The development, so this is a Quattro development. Quattro being, this one is out in the southern suburbs at Noarlunga Downs, but you would expect this style of townhouse to come up on the website very readily in the next 9 months in suburbs like Morfettville and Oaklands Park and Sturt and Clovelly Park and Kilburn and the like. So that type of once that's finished, forgive the scaffolding of things, once that is finished, that is a very attractive development, and you'll be able to have a look and work some cash flow. So people are looking, something with a little bit of land underneath it as against an apartment. You can use the website to add to a short list and compare across projects, and you can even export an investment report. Right down the bottom, the art developments on Flinders Street. Of course, there's 2 to go. So if you keep an eye out on the web, you'll see a big replenishment of stock over the next couple of weeks.
Do the properties come with a depreciation schedule, whatever you call it?
Yeah. Now so when you're looking at a project, one of our team will outline exactly what comes with that project. Some of the project builders like Divine and Metro provide the entirety. So they'll provide a year's landlord insurance at the start. They'll provide a depreciation schedule. They'll do the conveyancing for you, and then other developers like Quattro will provide only part of it. So when you come in, depending on the project, we'll outline what's to come and what's not.
What happens if you want to quit the property for 3 years?
Excellent question. So the numbers, when we first started, the question was, what happens if you want to get out of the property? The answer is very easy. So with the NRAS, there are 2 agreements. So there's ours, which is called a non-entity joint venture, which there's nothing on our title at all, or there's a head lease model which is used in the eastern states, which the manager puts a caveat on the title to protect their interest and their cash flow. Ours doesn't have that. So there's a mechanism where the property can be sold on realestate.com or through Brox or Fenwick Ellis, or so if you're 3 years down, you've had enough, the property can be sold on the market as any normal property. You're on the title, there's nothing on the title. All you need to do is communicate, and we provide our landlords with this information as you're going through the process. If the transfer, the buyer is an investor who wants to balance the income, and don't forget they've probably still got $70,000 of tax-free money to come, there's no transfer fee now at all. So it simply transfers out of, as the property transfers at the LTO, so does the allocation, and then Affordable Housing Consulting will deal with a new purchaser, and then you're absolved of any responsibilities with regard to the NRAS. If perchance you decided you wanted to move into it and perish the thought you wanted to give up on all that government money, we hope you wouldn't, and we'd counsel you against it. If you did, there's a fee of $1,000 because Affordable Housing Consulting will need to find a similar property in a similar suburb at a similar age and gift the allocation to them for the balance of the thing. So out of 560 properties, the consortium's only seen 4 change hands, and that have all been from property settlements from marital splits. So for no other reason have they been.
So that's stamp duty. Second time around.
Yep, they would. So the actual transaction for both the tenant and the purchase is exactly the same as if you bought a new spec home from Rossdale, or you bought a new property from any developer, stamp duties, if the stamp duty is applicable, it's applicable.
It wasn't applicable in the city.
Yeah, but it would be, depends on what the government's position is. And these incentives are all just for new properties. So the transaction second time would be as it would for any other property.
The tenants.
Good question. Who chooses the tenants? So there's a panel of 4 property managers, of which my esteemed friend James is HLB manage a very large number of our properties. So whoever the property manager is will advertise for the tenants, and they'll get as evidence every time we go out. There's a very large number of applications. It could be from 10 to, how many's the most you've seen?
Oh, probably about 30.
Is the government put a limit on how many properties each investor can have?
No.
And
No.
2, is there potential access to properties in the state?
Yes. Yep.
For you guys?
Yes and yes. Yes. So we've got relationships with similar-minded providers in Sydney, Melbourne and Brisbane. Perth is not quite working out, and Darwin, they just can't get it right up there. They've got allocations, but the price points are just too steep. So certainly in the eastern states.
Price points are too steep in Darwin. Why?
Oh, they've got. We've not been involved with any of the properties up in Darwin. There's one provider that has allocations up there, and they just haven't been able to get them for whatever reason. They're not selling.
Good evening. I won't take up too much of your time. I run 2 businesses. One's Pathway Mortgage and Finance, which has been going since in its 10th year now. We're based out at North Adelaide. We've had an association with HLB now for 8 years, where we had a joint venture actually called HLB Lending Services. So we have 2 entities we trade through. Primarily, my role here is to facilitate or talk to you about any funding requirements you may have for if you are considering purchasing an NRAS property. We've had a vast experience with it over the last 12 or 18 months through HLB and through Rob, so we're very well versed in that side of it. Our business is a broking business where we deal with a number of different lenders across the country. Predominantly the big 4 we deal with, and we deal with a lot of the major, or a lot of the regional banks like ING and Citibank and the likes. Over the years, I'll show you a slide in a minute which shows that some of the banks are a bit gun shy on NRAS some 6 months ago, and that has been opened up quite dramatically over the last 6 months by a number of different lenders. What we're just going to talk about is just using existing equity in your property to purchase. You can, if you haven't got available cash to do so, we can show you how you can use your property, your current properties as collateral security. Opportunities also exist if you have cash of your own money. NRAS now you can actually borrow up to 90%. Bearing in mind the banks will go to 80% with no mortgage insurance, and above 80% they'll charge a mortgage insurance, or what they call a risk fee, for their increased risk on that particular property to 90%. Or if you're in a situation where you self-managed super fund, then it can be a cash purchase through there. Unfortunately, the banks at the moment are not using NRAS properties within super funds to borrow. I don't think it's too far away, and that day will come pretty shortly that they'll be doing that as well. If you're using equity in your own property, you might have a property worth about $500,000. You might have a loan currently of $150,000, which is in the blue portion in the bottom. The green section in the middle is what is usable equity in my terms, and the $100,000 at the top is where the bank's 20% portion. They don't like to lend in that top 20% portion. So in this situation here, a borrower or homeowner here might have $250,000 available equity in their property, which are then going to allow them to use some of that equity to buy into an investment property. So in simple terms, you can buy an investment property for $500,000. Wrong terminology there, it should be back to $450,000. But at $500,000, you take $100,000 of your equity, which was part of this green section in here, into your property purchase, and using the new property as security as well. So there's no cash outlay if you want to go in that way. The stamp duty can be funded into that as well. So from a point of view of, from a structure point of view, you finish up with a loan of $500,000 on your investment property, which traditionally would probably be interest only because you want to keep your maximum tax benefit on that until this loan down here has disappeared. That's where your non-tax reduction portion is. So you'd like to keep that as principal interest, and this loan over here as interest only until this one disappears. the interest rate environment at the moment is really interesting because the banks are all after a smaller pie. You know, they want quality. They are all saying they want to lend, but they only want to lend to quality clients. And to do that, they're cost cutting all over the place. There's the professional pack loans are out there at traditionally they've been between 0.5 and 0.7% below the standard variable rates. Bank SA at the moment is out there at 1%. Suncorp's out there at 1.2% below the standard variable rate for borrowers in excess of $500,000. So it's worth shopping around to look at what's in the marketplace for professional pack loans and also on the basic variable loans. The basic variable loan is where you have no upfront fee and no ongoing fees. Something like Commonwealth Bank at the moment has a no fee loan at all. They've got it's at 5.7%, no application fee, no valuation fee, no settlement fees, no discharge fees, guaranteed for the life of the loan. So they're really competitive in the marketplace. Variable rates at the moment, 5.51 from most of the major banks at the moment. Fixed rates, this is where the price war has been just recently. They're down to 4.99 now for 2 years fixed. The burning question is, should I be going fixed or should I be going variable? No one knows the answer to that question because rates can go up tomorrow, they might come down tomorrow. We went to a breakfast, I went to 2 breakfasts in 2 weeks, spoke to 2 different economist spokes, one from NAB and one from Commonwealth Bank, and they had very different views on where rates are going to go over the next 12 months. And these guys are getting paid the big dollars to get this information out, and they were poles apart on their thoughts on the interest rate environment. But if you look at Rob's numbers in his calculations, I'm not too sure where you're at, but you might have been at high interest rates in your calculations. So this is even going to make the return back to the investor even more attractive. If you're in there at a fixed rate, even at 5 years, at 5.69, it's really going to protect you over that 5-year period. That your major cost, being interest cost, can't blow you out of the water. NRAS lenders, we gave a presentation here in September last year, and there was only a handful of lenders that were doing NRAS. And the question was why aren't people like the Commonwealth Bank in there, why aren't ING Bank in there and the likes? And the simple answer was when NRAS came on board, the banks weren't too sure where the ownership of the property stood. And they thought NRAS, they thought there was something with the government, they had a hold over the property in some way or another. The property couldn't be sold, you couldn't change tenants and all sorts of things. So they didn't have a great understanding of it. And over time, Westpac had the fair share of the market at the time, and Westpac, St George and Bank SA are all from the one stable these days. So there's only 2 outside of Westpac doing it 8 months ago. And now it's just opened up. All the banks have realised that the investor likes the product, it is attractive to them, and so they're all now on board, so we can go to any one of the lenders across the board for this sort of product, which makes our job a little bit easier across. That's from our point of view. Next step, if you are considering buying a property or even just looking at what's in the marketplace, we can talk to you about what's available, what sort of borrowing capacity you may have. Borrowing capacity has changed dramatically from one lender to another. They all use different servicing calculators. And we have the software in our office to show you how much you can borrow on your current income, factor in any potential rent from the investor property you may purchase, and look at the scenario from there, and look at structural wise as well, whether the property should be bought in husband and wife's name, just in husband's name, or just in wife's name, depending on their income levels and so forth. So we can't give tax advice, but we can certainly structure around what's going to be more tax effective for the borrower. That's me done. It's pretty simple. So thank you for your time, and I'll take some questions if you need to now or having a drink.
Yeah, does anyone have any questions for Peter? No? Oh, just one. Yeah.
Yep.
If you buy one property and we go through Peter, and, for example, I can just say we buy it through Macquarie Bank, and then the next property, are we locked in with Macquarie Bank?
No, it's depending where your equity is coming from. So if your equity is coming out of your existing house, you can drag some equity out of that and buy your next property through Citibank or whoever you might want to buy it through. So coming back to that previous slide on equity, if even something like Commonwealth Bank, for example, if your current loan at 150,000 is with Macquarie Bank, you don't want to use Macquarie for the investment loan. You can actually coming across to Commonwealth Bank, for example, they'll take a second mortgage using the equity out of your existing property. So your first mortgage stays as it is, and they'll use your existing equity plus the rental property as security. So all your current banking can stay exactly the same. You don't have to change.